Let's get your views then, Anneka. Let's start with you on where you see the Fed position itself, the optionality that Jay Powell is hoping to give him and the team there as a result of a faster taper, and where that leaves us in terms of the pace of rate hikes and the timing of rate hikes, Anneka. What is your assessment?
Good morning. Well, it feels to be consensual that, the hawkishness is going ahead with full steam. So, rate hikes, 2 or maybe even 3 rate hikes next year instead of the thoughts of only 1. But also in terms of the tapering, that tapering could essentially end already at the end of Q1 versus the end of Q2. But I think what's more important here is the new paradigm we're entering. And that new paradigm is, it feels like Powell, the Fed, shifting focus finally away from Wall Street to Main Street. It feels that this need to prop up markets, provide that Fed put, has abated. The S&P is up, almost 50% since the end of 2019. And I think the paramount point is this: even if the Fed does hike aggressively, even if from June of next year we're talking about 25 basis points of hikes every quarter in an aggressive scenario, by the end of 2023, we would still be around 2% or maybe even lower, which is below the 2018 interest rate level. And more importantly, will probably still result in a negative real yield territory. That's what it's all about, the negative real yield.
The support of the negative real yield, and you say that this is a pivotal moment, the shift to Main Street, away from Wall Street for the Fed, but part of Main Street, of course, is the jobs picture. Can they do that? Can they be aggressive in the rate hike cycle, but also meet their mandate when it comes to employment?
Well, I think the beauty of how this cycle has progressed is it feels that the economy is truly standing with more robust legs this time round. And it's sort of the economic engine working. So, higher levels of demand, therefore growth, therefore more labor demands, therefore labor wages, plus the pent-up savings, positive environments for corporates to invest, low interest rates, high earnings growth, tight supply chains, low stock levels. So from that perspective, it looks like the economic drivers could be strong enough for that to continue. And I think the other point, which is very, very important, even with all the uncertainty around Omicron, the point is that the behavior of people has shifted. People have gotten accustomed to the concept of virus, lockdowns, curfews. There's perspective from vaccines, from boosters. And I think the last point is, yes, the economy has already been rock solid, but US GDP is only approximately 1.5% above pre-pandemic levels. And if you adjusted for productivity growth, population growth, it could have actually, we believe it could have actually been around 3 percentage points higher. So there is ammunition.
OK, that is the important context there from Anneka. Eddie, let's bring you in at this point. Outline for us the inflationary challenges for the Fed and the credibility challenges as well as they wrestle with these 4-decade high prices stateside.
Yeah, and we've seen a little bit more of that over the last couple of days, right? We saw the PPI in the US coming in above expectations yesterday, and then in the UK as well, inflation really starting to heat up. And that must be worrying for policymakers. And Anneka points at the historically low real rates there. And I think this is an important factor for the Fed, right? Because she's right. There's a big Fed put in the market, and it has been there for a number of years now. And, I wonder whether the market is ready really for that stimulus to be taken away. But it will have to take some seriously aggressive moves for us to see, real rates in positive territory by next year.
OK, Anneka, where are the opportunities then at this point, if you take into consideration all of those factors that you've outlined for us, those negative real yields and support coming through from earnings? How are you looking to position?
Yeah, well, I think, we're back in yield-seeking territory, right? If the negative real yield will persist. And in a yield-seeking environment, 2 things stand out. I think from an equities perspective, equities still offer that yield opportunity, with good companies, with good cash flow generation, dividend payers, but also importantly, from an inflation hedge perspective, The only difference this time round is 2022 will absolutely be the year of stock picking. That's really our fundamental conviction, because, the days of sort of overarching, wide blanket, post-pandemic, indiscriminate buying are simply over. So that is certainly a window. And I think especially, we believe especially within Europe, Europe really has a lot to offer from a macroeconomic perspective, from a catch-up perspective, from a monetary policy backdrop perspective, but also simply from a valuation perspective. So that is a big opportunity area.
Okay, 2022 is the year of stock picking, Anneka. I love that call. Eddie, does that align with what you're seeing? And where are you looking to hedge inflation? What are you hearing from market participants?
Inflation hedges have been really hard to come by. If you just look at gold's reaction on that PPI beat yesterday, gold actually dropped significantly, and that's despite real yields not moving very much. And you know what? I think for me, yes, stocks absolutely. Things like banks will be very interesting on higher yields. But I worry about the call for stock picking because, active management has been in decline for a number of years, and I just don't see investors changing their ways very much on that particular one.